So, ladies and gentlemen, thanks very much for joining our Ask Us Anything related to real estate. My name is Avi Urban. Beside myself, we have by basic level of seniority who join us. We have Nati Natman, who basically is specifically focusing on investing in real estate, mostly outside of Silicon Valley. We currently invest in about 8 different locations. We have Asaf Urban, who mostly specializes in Silicon Valley real estate, and we have Ela Barak, who also specializes in Silicon Valley real estate. In addition, we should be joined by our lender from Bank of America, who is running to be the president of Bank of America very soon. We have 1 hour, and we want to make sure that this is done very efficiently and that we're answering all your questions. So we're going to start with roughly about 10 minutes of talking about the market. We're going to talk about the Silicon Valley market. We're going to talk about the investing environment outside of Silicon Valley. The first segment will be addressed by Asaf Urban, and both Ela Barak and myself will pitch in whenever necessary. The investment part will be by Nati Natman, as well as I will pitch in whenever necessary, as well as we have Arash Baman, as I mentioned, from Bank of America, who are going to be taking a few minutes about what's happening in the lending world and so on. So without further ado, and afterwards, we're basically going to open it for any question you may have, any subject related to real estate, as I mentioned, locally or investing. Asaf, please take 3 to 5 minutes to talk about our local market. Ela and me will pitch in whenever necessary. Thank you.
Okay. All right. Thank you, everyone, for attending. I'd like to first show you some charts. But before we get there, let me start with a little introduction.
Okay.
Okay. So my name is Asaf Urban. This year, I just reached my 6th year as a licensed agent, and 6 years with the Urban Group. Okay, so I'd like to now kind of go over a couple different data that is recent as of August this year. So before we jump into what we're looking at here, I just like to say that obviously we all know that we are in these unprecedented times, and we are in uncharted territories of America and where we're going and all this kind of stuff. So just remember to take everything you hear with a grain of salt from authorities and experts and professionals, including real estate agents. Okay. But what we're looking at today is the facts. Okay? We're looking at straight numbers, and how they fit into the narrative is the question here. Okay, so I'd like to start off first with Silicon Valley, Santa Clara County single-family homes, and we can see here that there is a price increase. Okay, we see from 2019 to 2020, we do see an increase in prices. I would take the volume, the closed sales, as with a grain of salt. It's relatively close to the previous year, but we also know that this is a unique year, and that there was possibly some homes withheld from the market due to some of the issues, some of the things that we experienced, and this could or could not be kind of like an affected number. It's hard to tell. Average days in the market is down. Okay, maybe you can interpret that as a increased demand from the previous year. And months to sell is also down, which also possibly couldn't be interpreted as an increased demand. Here we have the average price per square foot. And as we see, starting from March, it's been pretty consistently higher than the previous fall and winter. Okay. Again, how this fits into the narrative is up for interpretation. This is typical the inventory drop is typical, and we do see a sharp increase. We do see a little bit here of a dip in the February, March when Corona news hit the US a little bit more, a little harder. And then we do see this slight drop into the summer, which is also similar. It rhymes with previous years, but I wouldn't say it's repeating exactly. And then the last thing I would like to point out to here in the last couple of months is we do see this gap between median list price and median sales price. And then we see it coming together and then again widening. Okay. I'd just like to give an opportunity to any of the contributing parties to share any of their thoughts if they have any.
Ella, do you want to add anything?
I would just like to say that I see right now houses that are moving ready, going rather faster than the one that need renovation. I think also it's some of it is also because of the coronavirus. It takes more time to the cities to approve plans. So I think that people just prefer to take the move-in ready houses and pay premium for that. And sometimes it could be a high premium, and we see I saw a few times in the last month all cash offers and multiple offers above listing price for houses that are good location and move-in ready condition. So I would say that that is another thing that affect the house prices.
Yeah, I obviously, without the obvious, stating the obvious, is this year is a very different year than historically Silicon Valley real estate behaves. And Silicon Valley real estate behave in a very predictable patterns in normal years. And we see that, and I would like to share with you actually a slide and to just show you something. Let me share one. Do you want to stop the being the presenter, and I want to share something? Okay, I want to share a window. Share now, and I want to share this window. Okay, so I want to show. This is these two. Everyone sees those. Asaf, Ella, can you see it?
Yes.
Okay, so this chart, this is a very typical year, okay? And what we see very typical, the behavior, the frequency of the market, where we always have low inventory toward the end of the year, beginning, inventory picks up to the summer and drops, and it happens every year the same way. We are now here, okay? And this year was obviously a very different year. So all the stats that we are sharing with you about today's year is very much different than previous year. We do believe and hope that within a reasonable time, once the COVID pandemic is behind us or we have a cure for that, we'll be able to go back to normal. But right now, it's very, very much a different year. So that's the point here, okay? And now, let me stop presenting here. And with that, let's go now to Nati. Nati, talk a little bit about what we see in the investment market outside of Silicon Valley. Okay, let's talk a little bit about that, Nati.
Okay. Thanks, Avi. So what we see outside, and I will focus on the markets that we are more involved. So first of all, I don't see any price changes or any reduction in price that are worth talking about. And most of our focus, or most of my focus, is new constructions in the last 18 months. And even when we paused or when we stopped around last April and just being on the fence, trying to understand if the market is going downhill or maybe just stay the same, the fact that the interest rates are going to stay very low. What I see is that builders are pricing the houses very similar to 12 months ago. Even with transactional properties that we walked away because of the virus concern, the house was sold a few days after or went into pending a few days after, which tells me that the builders feel that they can sell the house at the list price very quickly. So we don't see any place for a price reduction. It might be different maybe with a resale, but since prices are almost the same, personally, I prefer to look at new constructions, and this is where I can provide the feedback. Another concern is really the ability of tenants to pay rent. And we don't see a lot of issues, but I'm starting to see here and there tenants that cannot pay. The good case or the preferred way is for the tenant to say, I cannot pay and leave the house. But sometimes they will just say, I cannot pay. I don't know when I can pay, and just leave it at that. And then we will have to evict. So so it's again, if people are buying for 10, 15 years, this is a different approach. But the unknown in the near future is a concern.
Let me add to that a few words. So we currently, to those who are not aware, don't know, we managing over 300 properties for our client and ourselves in 8 different locations across the United States. We initially, back in the March timeframe, we had 2 properties on the contract, new purchases, and we, as Manati mentioned, we walked away with the belief that with a current number, about 30 million unemployed people, a lot of them would not be able to afford paying rent as well as paying the mortgages. That with the government plans and moratorium on eviction and the ability basically for forbearance on mortgages and so on, obviously have buffered the situation, and we do not see that actually yet happening. We are aware, obviously, that the government have not extended the unemployment insurance, and we don't see yet a major impact when we're both on mortgage payment. We see some people actually falling behind. We see some, where we look at the statistic of people who are paying rent, that we see some moderation in terms of the people who are not able, but mostly the number are still relatively high, surprisingly, with about 30 million unemployed. I'm personally just finished an exchange, and we had another client who is finishing an exchange, and we had a very difficult time finding replacement properties because they are priced very high and they are moving very fast. Obviously, that has also to do something with we see that reflection also in the stock market, with the liquidity, and the stock market goes high, and the same liquidity is actually also basically happens in the real estate market, where people are concerned about their capital and trying to find some real asset to invest. So that is the case. With that, before we open it for question, I will ask Arash to give us an update on what's happening in the lending environment. Arash, a few 3 to 5 minutes about the lending environment. What do you see happening there?
Okay. Hi, everyone. I hope everyone is well. Certainly very different and unprecedented time as far as the fires and the pandemic, everything. Since March, a lot has changed in the lending for us. Every lender, they have added their own layers of risk to the loan. But generally speaking, lenders, they embracing for maybe a harder time. They assume that they're trying to basically change guidelines such that they don't have another 2008 in their hand. What they've done basically, what Bank of America has done is when you get an approval letter, back in the day used to be a blanket approval letter. The approval letter that I write to you for a loan amount, you could have gone to New York, to Florida, to Alaska, to Hawaii, and buy a home with it. Nowadays, approval letters are zip code specific. The country, we have divided the country into two types of zip code, a standard market or a severe market. If the property is in a standard market, the previous guideline to the pandemic applies. Previous guideline to pandemic was that if you're buying a home, that your loan amount, the loan amount is between $1 million to $2 million, you would need a 20% down. If the loan amount was below $1 million and more than 765, you needed a 15% down. So bank said if the property is in a severe market, not a standard market, you need 10% additional down payment. Majority of the market in Bay Area and in California around us is a severe market. Severe market basically means a higher risk market is a declining market. The entire Palo Alto, Los Altos, Menlo Park, Cupertino, Mountain View, they're all severe markets. Sunnyvale for most is severe market. There is a zip code in Sunnyvale that's standard. Only 2 or 3 zip codes in San Jose are standard market. Rest are severe. San Francisco is severe, most of the zip codes. So basically what has changed is the down payment requirement for most has changed. And also credit score requirement is 720 is the minimum score for bigger loans. Before we used to do all down to 680. Also, before the pandemic, if your down payment or your debt to income ratio, there is a factor that we use, it's called debt to income ratio, is the applicant's buying power. If you were slightly above the guideline or your down payment was slightly shy, we would request exception based on the other factor in your credit, in your income, type of job, your score, your cash balance, reserve after close. We would request the exception if you're outside a guideline slightly, and they will grant you the exception. Nowadays, they do not do exception on loan to value, which is also down payment, or your income if it's borderline. So lending is kind of toughened down. This is all temporary. And we're hoping with the vaccine that everything changes back to what it used to be. Other than that, I can answer any question you have. This is the only change we've had since the pandemic started. But go ahead, ask me anything you would like.
Arash, I have a question. You talk mostly about Silicon Valley real estate buying here, but what about investing outside of Silicon Valley? The area where we're investing is in the Tennessee area and Atlanta area and so on. Do you see the same restrictive lending requirements, or is it still what it used to be?
Yeah, the lending requirement, as soon as you're looking for a property, I'll need a zip code. I will look up a zip code within seconds, and I tell you if it's a severe market for a rental property in Tennessee, you're going to need 30% down payment. It used to be 20%. However, 25% improved the interest rate by about 0.5%. So all our clients were buying with 25% down. So right now that number is 30% down.
Right. And one word on the kind of good credit, what kind of rates are we talking about, both buying locally, kind of for one example as well?
That's a very good question. So rates for primary residents, bigger loans of over $1 million, most of the people are applying. You're looking at 3% on a 30-year fix, and for adjustable mortgages, you're looking around 2.375, 2.5. For a rental property, something with 25 to 30% down in Tennessee or out of state, you're going to be looking around 3.75, 3.625. I always assume high credit. One of the things that's advantageous with Bank of America is that we're still using rental income. I'm aware that some of the lenders, like Wells Fargo, you cannot use projected rent on the house you're buying. We can use projected rent as long as the house that you're buying is rented already under lease, okay? We can use that lease, and we use 75% of rental income to qualify you. If the applicant needs the rental income to qualify. Many lenders, because tenants, right now, a lot of tenants aren't paying rent, they don't give you credit for rental income, because even if they're paying rent, maybe in a few months, they're not going to pay rent. So that's what a lot of lenders, they stop using rental income to qualify, but we still use that.
Okay, thank you, Arash. Let's open it up for question. I see on the text, I have two questions. One I see there from Nitzan asking about, do you think cash offers are more common because people are cashing stock? I can answer it on the Silicon Valley side. So we see cash offers, but I'm not sure, I don't know exactly what's the source of that, whether they're cashing stock or not. We do see a few cash offers. We do see in our area, particularly, a lot of down payment. We are now in contract on a house in Sunnyvale that the buyers is bringing about $1 million down payment on a roughly about $2.8 million home, 30% down, more than 70%, 35% down. And we do see some cash offer. We see cash offer on high-priced home in the $4 to $5 million homes. But I cannot put my finger yet whether it's more than the usual one. So that's it. Arash, there's a question here from Alex Sander asking about what is the severe market exactly. Can you explain that, please?
Severe market basically actually is the way it's like they've done a blanket cover of the market in Bay Area. Basically, it's a declining market. That's what the bank thinks. These markets are higher risk. They're declining. And it's very interesting because the best area around us, which is Palo Alto, Menlo Park, Los Altos, Mountain View, they're all market severe. So to be honest with you, we've raised the question, why are you marking all of these? But that's how it is. We don't have an option of choosing or arguing with it. But basically means declining market.
Arash, is the declining market universal, or every bank has their own declining market zip codes?
I believe every bank, they have their own. I don't even know if some bank have this. I do know that all banks, they increased their down payment requirements after the pandemic. But I don't know if they follow this zip code and declining market or severe market we call. I don't know that, to be honest with you.
So there's a follow-up question from Alex. He's asking about where can he find more information about those zip codes which are in the severe market? Is it public, or you have to contact the lender themselves?
They have to contact me. That's the only way. It's our internet site, and I have to look it up. It's very quickly, I can tell you. It takes seconds.
Okay.
But
Arash, would you please put your contact information in the chat box, or Asaf will put your information in the chat box so people can contact you with questions.
Avi, the Bank of America firewall is not allowing me to join your Google meeting. Asaf can put it and they can contact me, no problem.
Thank you. Okay,
Thanks.
with that, let's open Ella before we Ella and Nati. Do you want to add anything, or we just open it up for questions to the other participants?
I will like to ask Arash. Arash, I didn't understand the 30%. Can we still get can we still put 25%? And does it mean that the interest rate will be higher than 3.75?
No, interest rate is the same between 25 and 30%. I have to really check to see if they can still do 25%. But 10% was added to as long as the property. If you give me a zip code, I tell you what zip code you want, and I can tell you that right now.
Okay, so
if it's the previous requirement for a rental property, Nati, was 20%. If it's in a severe market, 10% additional applies, so that makes it a 30% down payment.
Got it. Thank you.
Okay, so please, all the participants, ask any questions. We are here to try to answer it, obviously, if we can. You can put it on the chat box, or you can unmute yourself.
I have a couple more slides I can share if we have no more if we don't have any questions at the moment.
Go ahead.
Hi, can you hear me?
Yes, please go ahead.
Yes. I have more of an observation, maybe also a question, like for your opinion. Obviously, it's gonna be hard to predict, but first of all, I'm monitoring the San Mateo market, and I've seen a big increase in inventory in the last 2 months or so. I have a certain price cap that I'm looking below. And I'm even seeing now some price reductions that I haven't seen before. So that's my observation in general about the San Mateo County. Also, there's this huge elephant in the room that you haven't addressed. We are in the very turbulent political environment. We don't know what's gonna. Well, we know it's gonna be ugly. We don't know what's going to happen in the next 3, 4, 5 months, which will definitely affect the economy, the general environment, etc. So I don't know. People might just go back into their shells and stop putting properties on the market, or the opposite, try to sell as fast as they can. Anyways, I think. Based on predicting what's going to happen based on the current situation is a little bit, well, not a little bit, it's very tricky, because I think probably next February or March of next year will be hopefully when things will stabilize.
Yeah.
And I would like to hear your opinion on that. Thank you.
Okay, let me jump in, and anyone else can bring their 2 cents either. So yes, there is. I'll start with the first segment of your question about inventory. So first of all, there isn't a single market. Okay, there isn't. The market is segmented very, very much by obviously county, by city, by price point, by house type, and so on. So what we shared with you were county level stats. And as I'm sure you're aware, stats is a sort of is a good reference point, but you cannot base all your decision on such broad stats. You will clearly see market behaving differently in each city and each area by its price point. You see, typically across the board, we see that in every city the entry level to mid level is relatively strong, and the high end is relatively soft. I'll give you an example, my own example over the last few months. We just closed a transaction in Palo Alto, a house which was listed at 5.7 million almost, and my client got it for 5.1. Okay, we were able to negotiate a very $500,000 plus price reduction, and a very nice house, very big house in Palo Alto, good condition, and so on. On the other hand, we just went into a transaction here in Sunnyvale, in a very hot market, in the sort of middle of the market of Sunnyvale, with probably a little bit more, mostly of the high end of the market, and this area of Sunnyvale is very desirable. House which was listed for 2.3, we got it for almost 2.8, and there were multiple offers within 3 days. Okay, so there is not a single market, and we actually also had a listing in the market in one of the very popular market in Sunnyvale, where there was 7 homes on the market simultaneously, and within 10 days, all 7 homes went pending. Okay. So there isn't a single market. There is absolutely not a single market. And yes, you mentioned about the political uncertainty. Yes, there is a lot of political uncertainty. So I don't think that, and you actually touched it. I think what is very important that is impacting the Silicon Valley real estate market is the local economy. Everything else is derivative of the local economy. What we see, as much as it can be reflected by the stock market, particularly if you look at the high-tech sector in Silicon Valley, the stock market, the high-tech sector on the stock market is outperforming the entire market. It's leading the market. It's pulling the market. Obviously, about 20% of the S&P 500 are high-tech stock, and if it would not be for the high-tech market, the S&P would perform much worse. So definitely the post-COVID-19 world and the is definitely very much high-tech centric. And I do believe that Silicon Valley, as the global leader of technology, will be number one, the least impacted by the COVID-19, which is a fact. Of course, there are a lot of people who are impacted by that, unfortunately. Second, they will be the first one to get out of this grind of the economy due to COVID-19. And third, they will be the most one to benefit of the post-COVID world. And I do believe, yes, there is always the question about work from home impact. And actually, I just saw a new article today about Tim Cook talking about the new world post-COVID and work at home, and I didn't have a chance to read it yet. But in general, there is a belief that the post-COVID-19 world will be a world where we'll be in a sort of a hybrid approach for the high-tech companies, allowing people to work from home some of the time, other time work from having to come to work. As far as the president and the election, yes, that's a big one. But I think if you're going to look at it again from what's the potential economic impact on Silicon Valley, I do believe that in either case, the Silicon Valley will come out of it very strong and beneficial. And I do believe, that's my belief. Obviously, as you mentioned, time will tell and we'll see what's happening. That's my 2 cents. Anyone else can jump in, or if you have any follow-up question, you're welcome to follow up.
Let me continue with those charts, and maybe it'll help answer Alexander's question regarding San Mateo County. So as Alexander was saying, he says that there's been a huge increase in supply. And please correct me if I'm wrong, but this is essentially Alexander is saying there's an increase in supply and things are staying longer on the market. And okay, so to address that, in single-family homes, okay, in San Mateo County, we actually see a price increase, okay? And we see that the average days on market is actually less than the previous year, okay?
We do see some inventory increase, but what is it? What is
this
it?
is months to sell, and the average days on market. I'm not sure why there is a disconnect here, but and then we do see that the price per square foot is relatively maintaining itself, okay? But in you know, to support Alexander's statement, there is the condo market, which is telling a completely different story. Okay, so maybe this is what Alexander is referring to, and here we see you know, a significant price drop, and we see that the months to sell is much longer. Okay, but the average days on market has dropped.
Yeah. So
it also supports what Avi is saying, is that there are multiple markets and multiple segments. And I also think that the story here is also telling us that people are looking to come to the suburbs more. Okay, San Mateo, in my mind, is a little bit more density, more city type of living. And we can see that there is a little bit of maybe, you know, again, narratives are a little bit hard, a little bit more difficult to interpret than the trend is, but we see here that people are coming to Santa Clara County more, or the demand is higher now in Santa Clara County for single-family homes, okay? So it's very hard to make any type of conclusion about what is happening, in my opinion, but we can rely on the facts and work our way backwards from there.
thank you, Asaf. I would actually be curious. We have some people working in the high-tech industry here, and if you can share with you some of your thinking and talk and the conversation going on within the companies about this work from home and impact on your work environment and so on. So please jump in. I would appreciate that, and please pursue other questions if you may have.
We also have a couple questions here in the chat. This is one is investment properties. And it's from LH. are we looking at Georgia and Tennessee only, or are there new attractive places that we're looking at?
Nati, you want us to answer, or I can jump in, whatever.
On a regularly, I think that my focus is Tennessee. We also looked at Georgia, for many years, and including in the last few years. And what drives us is always to make sure that the numbers make sense. So the way that we identify properties, beside the location, is that we want to see properties that cash flow positive from day one. I've been looking around Texas lately, specifically for a client, and of course, if you increase the down payment, the property at one point will cash flow positive. So in general, we are always looking for new markets, but at the moment we are still in Tennessee, Georgia, because of the numbers.
So let me add a few words. So when we are looking at different markets, there are multiple categories we are looking at. Obviously, the numbers are one of them. We're looking about the growth of population. We're looking about ratios. We're looking about a lot of parameters. But at the end of the day, because we have a broad perspective, we can compare an investment in Georgia and Arizona and Tennessee and other places and what makes more sense. And for the last few years, we've seen that Tennessee, from a perspective of growth and cash flows and all that kind of arguments that go into the equation, is a good investment. I just sold a house in Arizona for about $280,000, which basically generates me about $1,400 of rent. Okay, when we are getting for $200,000 to $220,000 about almost $1,800 of rent a month. So there are right now, unfortunately, the situation is such that these places are making more sense to invest. Also, there is a question here from Evelyn. The median sales price have gone up according to your slides. Yet Bank of America sees that. Okay, that's a very good point, and actually Arash touched before. Arash, here is a question from Evelyn that's saying, why is the disconnect between the actually market performance and to what Bank of America consider that to be a risk area, whatever? Can you answer that question, please?
Avi, can you repeat the question, please?
Yeah, the question is, basically the stats are telling us that the prices, both in Santa Clara, the medians and average, both are going up on single family home. So why are Bank of America considering these areas as a declining market? Is that what they see, or that's what they project and believe?
They project that and they believe that because of the number of unemployed people and the people, basically out of work. The number of homeowners, they missed their mortgage payment 2 months ago, went up by threefold. So they're expecting that many people they're going to start having problem paying their mortgages. So they're expecting market to drop. One of the things actually they don't allow you to do, or they still do it, but it's very difficult to apply, is doing a cash out, refinance, or applying for a line of credit. That has become very difficult for all lenders, not just Bank of America. So they're not really keen for clients taking money out of their home, or, even though rates are very low, but those transactions are very difficult. And they're expecting market to change. That's what they see. So. Yeah,
Arash, but when you are looking, I don't know how Bank of America does it. Do they look at the very blanket area? Because Silicon Valley, but the stat that I have about Silicon Valley unemployment is we see that the area where they were mostly impacted in is the lower segment of the market. And we don't see, and when I looked at all the layoffs in the high-tech business and so on, I see that in Silicon Valley, it's very limited compared to other places. So how do they look at they look at the fact that you see a threefold? Is it here in Silicon Valley, or is it in other across the country? Are they doing
Yeah.
more fine tuning of that analysis?
Yeah, so what you actually say is exactly the question we raised, because they're looking at it as a blanket cover for the entire Bay Area, which is very wrong. I mean, if you remember back in 2008, even though there were hundreds or thousands of foreclosure, there was no foreclosure in Palo Alto or Los Altos or Menlo Park. Maybe there's one or two. So the way they're doing this is very wrong, and I agree with you. And actually, we have raised this question that this needs to be looked at, but no, they haven't, and we don't understand. Yeah, it doesn't make sense, but it is what it is.
Okay, good. Okay, other questions? Please go ahead and ask us any question you want.
There is a comment here from Alexander. There are so many unknowns beside COVID-19, and I would just comment back that this is very true. And there are also many unknown unknowns that impact us as well going forward.
You know, there is an adage on Wall Street that the stock market always climbs a wall of uncertainty or a wall of worries. And when everyone is confident about the future, it's already over. So but it's not an answer. I don't know what is the answer. There are always unknowns. It's the question of what are the trade-offs, because what we say also in our, one thing which I didn't mention, we have a regular investor webinars, home buyer seminars, and we have this ongoing Ask Us Anything. In our presentation about the Silicon Valley home buyers market, we talk about the fact that whatever decision you make, you take a risk, okay? It's just the question of what risk are you more comfortable with. What happens if you're wrong? What happens if basically price continues to go up and you're going to be sitting on the sideline and you're going to be basically be priced out? Or actually the way to ask this question is, if you believe that you are right now, let's just take a number. You're paying $4,000 to $5,000 a month on rent. So it's about $60,000 a year, okay? So if you believe you're going to be sitting on the sideline for 3 or 4 years, do you believe that the market is going to adjust for 60,000 or 40 or 50,000 times 3 or 4 years? If that's the case, it's okay. But whatever decision you make, it carries a risk. The question is, what are you more comfortable to live with?
That's it for the comments and the questions. Is there any charts or topics you'd like to cover at this moment?
Avi, I have a question. I know the answer, I think, but that you'll tell me, don't time the market. But is there an opportunity to actually time the market here? Meaning, do we think, for instance, that prices will go down? I truly believe long-term in Silicon Valley. So I believe that whatever, if it will go down, it will go up again in a year or two. Question is there an opportunity to time the market to buy low in a few months if it takes a dip and gain from this? I just don't. It's a big risk on top of all the other risks. So just asking.
Yeah. Honestly,
Esho, this is all right. Can I answer quickly that? They say if you see blood in the street, it's time to buy.
No blood yet.
So exactly the point. So the honest answer, Eshel, is I don't know. I don't know what's going to happen. I just know. And the only way that I can articulate that is to try to put my hands around it. So let's say, what do you think? It's going to drop 5%, 10%, 20%? What do you think is going to happen? So that is the first question you have to ask yourself. What do you believe? Will it drop 10%? And then you ask yourself a second question. If you're a renter and you see it's going to drop 10% in the next 2 or 3 years or 5 years or whatever, so then do the math. Is you're going to pay rent for $4,000, $5,000 a month for the next 3 to 5 years. This is a guaranteed loss, okay? The fact that you were going up to the market and buy a home, will drop more than that? What happened if you're wrong? What happened if the market does not drop and prices continue to go up? And I would say the way to also look at that is also think what's going to happen to the company particularly the people who work in high tech. Do you still believe that the high tech industry is going to continue to do well? Do you think the company that you're working for will continue to do well? And if that's the case, then take all that into consideration. Other than that kind of an answer, I don't have a better answer. I don't have the crystal ball to be able to answer you this question. Any other questions?
Joel has a question about rental properties in the Sacramento area. What do you think will happen to those prices?
So the simple answer is I don't know, but we do have. I personally own was a partner of some Sacramento property for many years. It's been performing very well. I think what the best answer for that is to put you in touch with a local agent, which I can definitely refer you to one, which I've worked in the past multiple times, and he will be much more qualified to answer that question than I am. Okay, so if there are no other questions, all I would mention is that we have another, I think less than 2 weeks, we have our home buyer seminar in Silicon Valley. It will be a webinar where I think it's about 2 hours where we're going to talk about the Silicon Valley real estate in much more detail. And I would have there also Arash there, Allah and Asaf will be participating as well. And we're going to be talking about the Silicon Valley market for as a home buyer as well as Silicon Valley for investors. So anyone who would be interested, definitely please join us. There is an Evelyn question. What makes Tennessee such a qualified place to invest in? Well, that's a good question. So we currently manage, I think in the Nashville area, roughly south of Nashville, we have, I would say, approximately about 80 to 100 homes that we manage and own ourselves. And in the Knoxville area, we have another about 30 homes. And we're looking to other areas in the state as well. And depends on where, from Nashville, which is a big city, to Murfreesboro, which is a university city, and it has Nissan plant, and it's basically a hub for a lot of those companies such as Amazon and so on. As well, if you go to Knoxville, we see also university city, we see government facilities there, a lot of research lab, nuclear lab research there. And in general, it's a nice place where people enjoy living there. And the cost of housing is not astronomical compared to Silicon Valley. We are buying homes in this Leah and Eshel, please mute yourself. And so basically, we buying homes which are roughly in the 2,000 square feet price point for about 200,000 to 250, an amazing value for your house, and we get a tremendous rent there. So that basically what makes it, obviously the numbers, but what makes the numbers is the fact that these are all very well-established cities with a lot of industries that people can support those kind of prices. And Nati, please jump in if you have something to add there.
No, I think you covered most of it.
So we are just about almost 7 minutes away from the hour. If you guys have no other questions, let me see if there is any other question. Okay, so any other things? Okay, thank you very much. Appreciate your time, and hopefully some of you might be interested in joining our other seminar, the investor seminar, webinar, as well as the home buyer seminars. And obviously, both Ella, Asaf, Arash, and ourselves are always available to answer any question you may have. Thank you very much. I appreciate your time. Have a safe day, and all the best for everyone. Thank you very much.